Alright, so I had a wonderful viewer ask me, Eric, what extra risk might I take on buying T-bills versus CDs? Can you do a video on that if there is any? Great question, David. So in this video, I will talk about what T-bills and CDs are, what their risks are, and which one is better right now. I'll also show you a quick tip on how you can earn significantly more interest on your savings. So without further ado, let's get started. Starting off, what are bank CDs? This is when you agree to lend money to a bank for a fixed amount of time, typically between a couple months and a few years. The money must remain untouched, or you do risk a penalty fee or lost interest if you want to withdraw your money early. Now, CDs are very common cash investments for a lot of people because banks generally offer higher interest rates than savings accounts since your money is much less liquid. The interest rate you get is also guaranteed for the entire term, making it especially good if interest rates were to fall. Now, Treasury bills or T-bills are very similar in the sense that you're lending money to the US government also for a fixed amount of time, generally between 1 month and 1 year. In this case, you can't withdraw your principal early, but you do get a relatively high rate and amazing tax treatment. The interest you earn is exempt from state and local income taxes, making this a really good option for anyone living in states with high taxes. As a result, T-bills are very common among higher net worth individuals because they only have to focus on federal taxes, and the interest rate you get is also guaranteed for the entire term. So now that we know the bare bone basics of bank CDs and Treasury bills, which one is better right now? So when it comes to CDs, you can actually purchase it directly through a bank's website. For example, I personally think Ally Bank is pretty good with great customer service, high interest rates, and a nice customer user interface. Now, I can easily get a 1-year CD earning 2.75% interest with a bank that I like to use. And these rates are much higher than what I would get with a traditional high-yield savings account. I can also deposit however much I like, as long as I don't go over that traditional $250,000 FDIC insurance limit per bank. But as with most cash investments, you do sacrifice potential returns for that guaranteed interest rate. So for example, if CDs were to rise to say 3.5% in the next few months, I may miss out on potential profit because my money is locked in for 1 year. So if you do plan on buying a longer term CD, it's definitely worthwhile to shop around for the best rates and to consider how much interest rates are likely to increase in the near future. However, as of September 2022, Treasury bills are easily beating many of the highest paying CDs out there right now. Currently, you can actually get about 3.6% interest on a T-bill that expires in 1 year. And that's nearly a full percentage point higher than Ally Bank. And this doesn't account for the additional savings of state and local income tax. And funnily enough, even the 4-week Treasury bills are offering 2.7% annualized interest, pretty much matching the best rates that you can get with a 1-year CD at Ally Bank. This means you're getting the same annualized interest rate, but not having to lock up your money for 12 months. And considering that the interest rates on treasuries have risen by about 0.4% in August alone, it can be very practical to just use these shorter term T-bills until the interest rates start to stagnate and you can lock in a definitively very high interest rate on your T-bill or your CD. So personally, I would say right now that T-bills are significantly better. Additionally, because you're lending money directly to the US government, you can actually deposit millions of dollars and your money is still protected and fully backed by the US government. And this makes it a really good option for high net worth individuals who don't want to use multiple bank accounts to still have that FDIC insurance. Now, as with most cash investments, there isn't any volatility and there's not really any risk aside from interest rate risk and opportunity cost. The only major downside when it comes to treasuries is that you're probably buying them from Treasury Direct, a government website. It's not the most user-friendly website, and it can be quite annoying if you make any errors or need to call customer service. So you'll get much better rates when it comes to treasuries, but you may miss out on the convenience and the customer service of a traditional bank. And similar to CDs, you may want to consider whether rates will continue to rise before locking in a long-term T-bill. And for the quick tip to save you money, you may also want to consider purchasing bank CDs or treasuries through a broker like Fidelity or Charles Schwab. These brokers will purchase CDs from banks in large quantities and divide it up into smaller chunks for investors to purchase. Now, these interest rates tend to be much higher than what you would get from a bank directly, and they offer a wide selection of bank CDs to choose from. And best of all, your money is still FDIC insured, and you can easily surpass that $250,000 limit by buying brokered CDs at multiple banks. So for example, on Charles Schwab, you could buy a 1-year CD with Capital One offering over 4% interest, and that's significantly more than what Capital One offers on their website at just 2.75%. Now, brokered treasuries are very similar as well, and they currently offer a bit more than going through Treasury Direct. Now, these brokered securities are a bit more complicated, so definitely check out my more dedicated videos linked in the description down below. Now, finally, I do want to give a quick shout out to Series I savings bonds, which are currently offering 9.62% annualized interest for the next 6 months. These are US government issued bonds that require you to lock up your money for 1 year, but they do pay you a really high interest rate that is automatically adjusted for inflation every 6 months. So if the inflation rate is high, like it is right now at say 8%, these bonds will also pay 8% for 6 months. The interest is also exempt from state and local taxes, just like Treasury bills. And mathematically, I-bonds are probably the best option if you have savings that you don't plan on touching for at least 12 months. There are a couple rules and penalties, so again, if you want to learn more about their specifics, feel free to check out my more dedicated video linked below as well. And as always, if you find this type of video helpful, feel free to leave a like, subscribe for more, and share it with friends and family. Love you, thank you so much for watching, and have a great rest of your day. Take care. I'll see you soon.